Hi, welcome back to our show, Stock Masters. I'm your host, Kaela, and today we're going to be talking about a very important stock, Zoetis Inc. Today you'll be hearing from my co-workers, Sheenah, Caty, and Emilio. And we'll be discussing whether we should be buying, selling, or holding our stock on Zoetis Inc. And now to get a little bit fiscally fit in the company, we're going to start with the company overview. Starting off, we have our CEO, Kristen Peck. Her vision for the company is to have their products, services, and people be the most valued by animal health customers around the world. Zoetis Incorporation is currently in the industry of pharmaceuticals in the animal health sector. Its leading competitors are Johnson & Johnson, Syneos Health, and McKesson Corporation. Now heading into the financial ratios, we have Caty.
My name's Caty, and let's look into Zoetis Inc.'s financial ratios. These are the financial ratios for Zoetis Inc. 2019 and 2020. As we can see, the most concerning things would be the turnover ratios are negative percent change. A decrease in turnover can show that Zoetis was not using its assets efficiently to produce sales. Also, higher debt ratio means that it has taken on a larger amount of risk and is thought to be highly leveraged. This includes a higher risk to investors as fewer earnings are able to meet interest payments. The most promising for Zoetis Inc. would be that both current and quick ratios have a high percent change, which means that between 2019 and 2020, Zoetis' ability to generate enough cash to pay off all debts became more effective for the company. Here are the liquidity and solvency ratios for Zoetis Inc. for 2020. The green arrows mean that they've increased in the past year, and the red arrows mean that they've decreased. As I said, for the current and quick ratios, they've increased, so that means that Zoetis' ability to liquidate their assets increased over 2019 and 2020. For the solvency ratios, we would want to have higher solvency ratios to cover the company's long-term debt. As we can see, though, they have been declining, so this means the company, over time, has had a harder time covering their long-term debt with their equity and assets. Now, I'm going to turn it over to Sheenah.
I'm Sheenah, and we'll now be moving on to financial ratios for one of the leading competitors, Johnson & Johnson. So as we can see here, the chart shows the financial ratios for Johnson & Johnson 2019 and 2020. On the right, the percent change is shown in red and green to show increases and decreases over the year. First, we are going to take a look at Johnson & Johnson's solvency ratios. Overall, this means the company's ability to meet its long-term debt obligations is high and would be utilized for future business lenders' decisions. This further demonstrates its financial leverage. Now, I will be talking about the liquidity ratios. This is a measure of a company's ability to pay debt obligations, so in this case, Johnson & Johnson has trouble to meet its obligations and fulfill its duties. This is usually focused on the short term, and clearly Johnson & Johnson is facing some trouble here, as we see with the red arrows. When it comes to outperforming, J&J outperforms in its solvency ratios, and Zoetis outperforms in its liquidity ratios, as we discussed in the slide before. And now we will be bringing in Caty to talk more about the financial analysis for Zoetis.
As we can see here, over the past few years, Zoetis' revenues have been increasing.
And with that, fixed assets have also been increasing as there's been expansion in terms of the machinery and buildings.
With our revenues increasing, we can see the trend of our cash increasing.
But as revenues have increased, so have the expenses. And with that, there's also been some foreign currency loss also contributing to the expenses.
Now we're going to pass it off to Kaela.
Thanks, guys. Now we're going to be looking at the stock performance of Zoetis Inc. So for Zoetis, they've had a 52-week percent return of 22.72%. And this is outperforming the market, which was at 11.56%. So they outperformed by about 11.16%. And now, over the past 30 days, their stock price has been falling. It was about $199.79, and it's decreased all the way to $192.54. And a lot of this can be due to the fact that a lot of Americans are actually starting to go away from eating beef and dairy, which is a problem for Zoetis as they're a huge healthcare for livestock. And now, although this looks bad, their CEO, Kristen Peck, is very hopeful for the future as they're seeing lots of growing expansion internationally, especially in places like Brazil and China. And now we're going to look at the stock price of Zoetis over the last couple of months.
So here you can see there's been a steady increase, and then we reached our peak here around January 1st. And now we've been on a pretty much a decline since then, although like I mentioned, the CEO, Kristen Peck, is very hopeful for the future that it'll start to increase again. And now I'm passing it on over to Emilio to discuss beta, risks, and capital budgeting.
In terms of the beta, Zoetis has a beta coefficient of 0.77, which means that it's less risky than the average investment in the market, as compared to McKesson Corp, who has a 0.71 beta, and Syneos Health, who has a 1.84 beta. Moving on to the risks. Some of the risks that Zoetis has to deal with is supply chain disruption and developmental regulations. These come from external factors such as COVID-19, but this isn't necessarily unique to the pharmaceutical industry. A unique risk that Zoetis has to deal with is the relationship with Pfizer. Zoetis is dependent on Pfizer to prosecute, maintain, and enforce certain intellectual property under the patent and know-how license agreement. This could lead to more time-consuming research and development and expenses that Zoetis has to pay to develop their products. Let's talk about Zoetis' capital budgeting. Zoetis prioritizes their research and development spending mostly on veterinary medicine. Their research and development expense in 2020 was $463 million. This is a $32 million increase from 2018. Their research and development efforts consist of more than 300 programs and reflect their commitment to develop better solutions. Zoetis makes their strategic investments in their research development following 4 criteria: strategic fit, technical feasibility, return on investment, and needs of customers and the market. That's how Zoetis finances their operations. I'm going to pass the mic to Kaela.
Thanks, Emilio. In order for Zoetis Inc. to finance their operations, they have a mix of debt and common equity. The common equity for the fiscal year of 2021 was $8.25 billion. And now, Zoetis Inc. had no preferred stock for the fiscal year of 2021. But they did have a mix of both short-term and long-term debt. The short-term debt was $1.797 billion, and long-term debt totaled up to $6.65 billion. And now, what you've all been waiting for, the big question. What should you do with your Zoetis Inc. stock? And now I'm going to pass it on to my friend Sheenah to give us the answer.
For those of you with Zoetis Inc. stock, you should hold your position. In the short term, there may be a decrease in stock price. However, over the years, we've seen a general growth in the stock price. So for those of you who don't own Zoetis Inc. stock, we'd recommend invest while you can because it's only up from here.
And now to wrap it up for the night, I have a quote to share with you from my dear friend Benjamin Franklin. An investment in knowledge pays the best interest. Thank you for tuning in!